Good morning. Welcome back to the Retirement Report. I'm Hank Parrott, your host. All right, I'm going to finish up this part about the markets. I want to really kind of hone in here and just reassure you on the one hand, but also voice of reason by sharing, learning from the past, if you will. Recognizing, I remember, for instance, in 2000 through 2003, having clients come in at that time, right, around 2001 in particular, or excuse me, through 2002, that 3-year period. But I had people coming in the middle of that say, when are things going to get back to normal, right? Because if you look at the market, at that time, we had a 10% drop in 2000, followed by a 13% drop in the market for 2001, and a 23%, just when you're thinking, oh, the worst has got to be over, we're down 23%. And what happens in 02? A 23% drop. It duplicates, and basically we end up with a 46, almost 50% loss in the stock market over that period of time. And there were a number of things. 9/11 I mentioned being one, NASDAQ, the bubble bursting with tech. There was some mutual fund issues, aftermarket trading. There was a whole bunch of financial issues going on at that time that led into that and into a recession, right? And that's the other part. Look at the economy. So when you have a bear market, typically we're going into recession. What was the one after that? We just climb out of that, peak out in October of 07, and all of a sudden we got the financial crisis, right? And from October of 07 to March of 09, a 55% drop in the market. Okay, now what happened then? That's followed by the longest bull market in history. So understanding again though, going back to that last one, another, on the financial crisis, another big recession. In fact, one of the worst recessions. They talk about that one as the Great Recession, you know, likely almost like a depression. That's not what's happening right now. Okay, what we have right now with this, and maybe it's an over concern, but maybe it's also a good idea to be following the guidelines and just doing what's good. We're all developing better habits, right? The things we know to do anyway, just with the flu. And this is one of the things to keep in mind when we talk about the flu as an example, right? Just in the United States, it's something like over 200 million people get the flu every year. 200 million. Okay, so way more just in the United States, and I think we're up around 1,300 or something right now as far as the coronavirus. And what happens with that? We have hundreds of thousands of hospitalizations, and the death rate can range anywhere from 20,000 to 60,000 per year, just in the United States, not counting the rest of the world. So again, some perspective here as far as what this looks like, and again, developing these habits, heck, we should be doing it anyway, just for that reason alone, right? Just for the regular flu, and we don't want to pass this on, and that's the biggest reason for me. I'm not as concerned personally as far as health stuff goes, and those, as far as these viruses or flu, but I've got clients that I meet with on, you know, every day. I want to be considerate of them and be extra careful with my own hygiene and my own habits, and being careful because I wouldn't want to pass anything along. I'd feel terrible about that. So I'm very careful that way. And around my office, it's the same thing. And with family. If you've got at-risk members that are, you know, in particular 75, 80 or higher, or with underlying health issues, you want to be careful. We've got, I think, up to 40 deaths right now in the United States with this, but if we look at it, I think more than half of them were in a nursing home. So again, the highest risk population, if you will. Keep some perspective, and here's the most important part. Whatever those are, take the advice of the health professionals out there, do the right things, not only for yourself, for your family, and for those in your community around you, but also keep perspective here. So I was sharing with you about these different pandemics that we've had over the years, going back to the last 20 years, and I'll finish up again. MERS was another one, May 2013, following 6 months following that outbreak, we had a 10%, almost 11% increase in the stock market, and within 12 months it was up by almost 18%. Ebola, right? That's one that's been in the news. They've talked about that in terms of response and how much more that affected us and how much more rapidly as well. March of 14, that happened. The market within 6 months was up 5%. Within 12 months, it was up over 10.5% in the 12 months following. stay invested, all right? Now, one of the things here, Zika was another one from January of 2016, by the way. Market was up 12% within 6 months, and within 12 months up 17. I think this is going to be short-lived. I think we're going to go through a tremendous amount of volatility. It's also an election year. That adds volatility typically. We'll see how that shakes out. But I think over the next couple of months anyway, we'll probably see, again, more volatility, but positives in the market. I think the market overall is likely, okay, not with other unforeseen events that could happen, but just talking about the most recent here with the coronavirus, end of year, the expectation is we'll have a positive year. We'll make money. All right, so we'll recover from what is now, I think, somewhere around a 25, close to 25% down in the market. I think we may be, we may see a good positive day today that could mitigate some of those losses. Again, over time, especially over the next 2 to 3 months, that should smooth out. All right, again, most importantly, long-term investing. Long-term investing isn't about worrying about what's happened in a few months. For that matter, it's not even happening over a year or 2 years, right? Think about it. The bear market of 2000 through 2002, that's a 3-year period, okay, that we went through negative years. You got to stay invested to catch those upswings as well. Over the last 20 years, the market's averaged about 6% a year. The expectation is over the next 15, 20 years, looking at most of the research out there and most of the others that weigh in on this, like BlackRock, Vanguard, and other names you'll know, that's the expectation as well. It's not going to be as strong as the bull market we've had in the last 10 of 14% increases, so we want to be realistic and practical here. But again, long-term investing, figure about, if you're depending on how you're invested and how much you have, stock to bond ratio and that kind of thing, but looking at market returns somewhere in that 5 to 6% range is probably realistic. Okay? Now, if you're concerned about these things and you want to, or if you, here's the part that I want to get across more than anything, now that we've got some perspective here hopefully, is be thinking this is a great time to review your plan. Having a plan is the most important thing, and that means an investment plan that doesn't haphazardly put together, or that you're not just looking through your 401k and saying, oh, that looks good and that looks good, that kind of thing, right? It's a little more involved. How do you blend together different asset categories, how we go about utilizing modern portfolio theory to build that portfolio and manage risk. This is one of the biggest things you can do right now. All right, stay invested, but manage risk. So it's a good time if you've got high-risk things in your portfolio, take another look at that, and maybe this would be a good time to prune those out and manage that risk while still looking to maintain, of course, that market return. If you'd like some help with that, I'm going to make it easy. First 10 callers to my office, the number is 615-376-5325. If you would like a personalized investment analysis of your investments, of your portfolios, showing you, I'll pull Morningstar reports and I will dig down in deep with you on these, not just the macro of how much stocks to bonds, all right, or in your mutual funds, that kind of thing, but digging into those funds and seeing what kind of stocks you have. If there's a lot of overlap, which I see quite commonly, someone might have 20 mutual funds, but if those 20 mutual funds all own most of the same stocks, are you really diversified? You could just narrow it down to one fund almost, right? So I'll show you that kind of thing as well. Teach you about bonds. We'll look within yours, see if you have any high yield bonds, long duration bonds. These are things that can also add risk to your portfolio, and I'll show you ways that you can minimize that. So it's a comprehensive plan, the investment analysis just being a part of it, but in light of the volatility today, this may be one of the more important ones for you, and it certainly is. I mean, your portfolios, your investments, your savings, that's the financial engine that's going to, fuel your retirement and provide the income you need to maintain your standard of living, attain it, maybe add fund money to be able to enjoy retirement and not have to worry. You might be stressing right now. Am I even going to be able to retire with what's going on in the market? A proper plan is going to reassure you. My clients are not worried about that piece. They know their income is going to be stable because of the plans that we put in place for them to assure that that will happen. So again, if you'd like that kind of look at your investments, as well as getting into questions you might have about Social Security, taxes, another big one. We do a lot of tax planning because this is a way, if we can minimize taxes, right, that's more money you get to keep. It's going to help your money last even longer. So again, first 10 callers, 615-376-5325. Tess is standing by. She'll get your information. She'll send you out a checklist of things to bring to your appointment with me. And when you come in to see me, I'll give you a free copy of my book, 7 Steps to Financial Freedom in Retirement. All right. If you know, one of the things here, I'll be talking more about these things, and again, if you come in and see me, I'll talk more, more about how to invest properly to not have these this kind of volatility worry you. But in the meantime, another part of that, you go through all this. We've been talking about the Secure Act and how effect that might have on estate planning. And I thought this might be a good time to get into some of the basics of estate planning, to revisit that, because it's also a great time to review if you've got wills or trusts, or maybe you haven't, maybe you procrastinate and don't have any of that. Well, this might be a good time to take a look at that as well. All right, so join me here today is Jack McCann. Jack's an attorney over in Brentwood, excuse me, I say it again, right? Cool Springs area, which it happens to be that Brentwood-Franklin line there. So he's in Cool Springs, over near the mall. Hubbard and McCann, right?
Yep.
Did I get it right?
McCann,
Hubbard and
yep.
McCann. I'm always it's Jack who's all I'm talking to. So I've known Jack, I think 7, 8 years now at least. And before that, worked with his partner, an older partner, Keith Solomon. So going back probably 10 plus years. One of the things, you're always looking for good attorneys that can help you with the kinds of things that you're going to need. And we talk about estate planning being one of those. Jack also can be very helpful when it comes to real estate. And those are two things that go in quite blend together quite well. All right. One of those areas that we're going to talk about today, though, is that of the estate planning and some of the basics. So Jack, we'll start with probate. So one of the things with when someone dies, that they're, if they've got a will or if they don't have a will, they're going to deal with probate. And I think we have, what exactly is probate? So let's talk about how probate works and what that means.
Sure, yeah. So probate is the process of essentially changing title from the decedent to the new owner. Obviously, we would expect the new owner, we call those beneficiaries. They can be the heirs at law, the people who are the natural heirs of the decedent, or it could be somebody else. You don't have to will everything to your kids. You can will it you can spread it out. You can give to families, to charities. You can do whatever you want. The catch is when we do probate, we do that when the person passes away. If they have a will, which is a document that explains where they want things to go and how they want it to get there and who's in charge of things, a will is very important. That's called testate probate. If we don't have a will, then we've got a problem. The state provides a means of getting things to beneficiaries, but it's probably not the way you wanted it to go there. Probate without a will is called intestate probate, and the only beneficiaries under intestate probate are the heirs at law. So your natural children, spouse, and siblings if you don't have children. I do a lot of probate. I like it when we've got a will, especially a more recent will, which is up to date and explains who they want to be in charge. The problem, unfortunately, we do a fair amount of probate where there is no will, and that always creates problems. And the thing that people don't realize is intestate probate is more expensive than testate probate. Dying without a will is more expensive than dying with a will. And the problems that we encounter through that process of probate when there's no will, far more complicated. In my experience, the heirs fight over things. Everybody wants to be in charge. Nobody trusts anyone else, which it's kind of that too many cooks in the kitchen phrase. When we've got no will, everybody's got the right to be the cook, and they all fight over, you're not doing that right, you should do it this way. When there's a will, you can designate who's going to be in charge. You can take into account, in your opinion, who would be the most responsible, most mature, most level-headed person. And that's who we want in charge during probate. So a will's a very important part of the process.
Let's take a look. In fact, we've got a slide, Marilyn, if we could get that up there, what exactly is probate. And we'll hit these bullet points. Jack just did a good job in covering those, but just to make it easier for those at home. One of the things, we got that slide? There we go. I'm abandoned. What exactly is probate? So objectives of probate, as Jack was just talking about, resolve disputes. And if you don't have a will, you're setting it up for more disputes. Paying off creditors. So if there are monies that need to be owed by the estate, there we go. If there are monies that are owed by the estate, by the deceased, that needs to be taken care of. Inventorying assets, making sure that we know everything that they've had. We're doing a little measure there. appraise the assets, and that may come in particular with real estate, and maybe there's potential tax issues involved, so we would need to know certain valuations there. And this can be very helpful too, by the way, in how you do your planning. Step up in basis, we'll talk a little bit more about this, but this is where appraisals may come into play as well for establishing values going forward. Changing title to the assets, we'll talk about other ways for that, and distributing one's estate in the end. So when we come back, I'm going to get into the three main reasons why you might want to avoid probate. Okay, but first we're going to take a break. Join us here. We'll be right back on the Retirement Report.